FX Nation, what's up, guys? Welcome to the first video. And in this video here, we're going to call this is going to be our Forex View playlist. So be on the lookout for a playlist on this channel called Forex View. And that is where all of these videos are going to be. So Forex View is going to be videos, essentially me breaking down concepts of Forex, teaching you everything that I know about Forex. And good thing about it is we're going to do it for free. Every little thing. I'm not going to hold anything back. I'm not going to hide anything. This is literally just, I'm a straight up person, so I'm just going to tell it how it is. And that's just it. So all of the videos moving forward that consist of you learning Forex are going to be under Forex U in a playlist. Okay, so it'll be easy for you to find. But this video here, I'm going to call the foundation, and we're going to talk about in this video the three core things that you need to be a trader. Okay, because if you don't have these things, then there's no way that you're going to succeed, and that's just that's just point blank. So we'll talk through the three core skills that you need, and then at towards the end, I have some videos to get you through like literally the very kindergarten basic stuff that you should know, a quick high level overview, because we need to get through that anyways. So we'll get through all that stuff on this video, and then on the next video we'll start breaking stuff down further in detail. So I want to make sure that since most of everybody here that I'm aware of have never traded before, don't know what Forex is, or may have just heard about it but really never got into it, I want to make sure that we start like at kindergarten level and then work our way up from there. Okay, so if you run across this and you are a trader, you have been trading for a while, and you're looking, you may be struggling, or you're looking for something to kind of help take your trading to the next level, definitely in the right channel. We can definitely help you with that. But just bear with us while we get through this very basic, stuff of Forex for the new guys or new gals that are here. So let's just go ahead and jump right into it. So when we talk about Forex, we got to talk about what our goals are. Okay, so our goal for this channel is to help people develop a full-time trading business, all right, that produces consistent, above average profits under various market conditions. Now, this means that you can perform in any type of market, right? And we want to help traders reach this. We design a 5-step approach to this, okay? Our objective here is to familiarize yourself with these 5 steps that you must take, all right? So let's just go ahead and jump right into them. And the first thing is going to be the 3 core skills of trading are going to be your trading strategy, risk management, and trading psychology. Okay. So what do I mean by trading strategy? All right. So when we're talking about trading strategies, is there are hundreds of thousands of trading strategies out there. All right. And I've gone through a ton of them when I first started trading. I've traded from strategy to strategy to strategy, and I can tell you most of them don't work. There's only a couple of them that do. Okay, and without a trading strategy, you cannot trade successfully Forex. Okay, you need a trading strategy, and not only just a trading strategy, you need a trading strategy that you've back tested and you know that it works. You know that it's going to give you the results. Okay, so one of the biggest things about the trading strategy is the back testing portion of it. Okay, you have to back test the strategy so you know whether or not it works, most importantly, and then you'll actually also have the data to support and give you confidence in the fact of that this trading strategy can produce results and profits for you. Because it doesn't matter if you have a trading strategy, because if you haven't back tested it, you don't know what you're going to get out of it. And you don't feel confident. You don't have the confidence when you're trading if you've never back tested a strategy. However, if you've back tested a strategy and you know that you've back tested it for 2 years, let's say you've gone back in the charts, back tested it for 2 years, and out of those 2 years, it's pretty much producing, anywhere from 70% or above winners every time that you trade. You have confidence now every time that you go trade, as long as you follow your rules for that strategy, that you're going to get 70% return rate because you know what you've back tested. All right. So, very important trading strategy, number one. Number two is going to be risk management. If you don't know how to manage your risk, there is no point in you trading. Okay. You don't belong in the trading game at all. All right. Risk management. If you cannot manage your money on a trade, if you don't manage how big of a percentage you're leveraging your account, if you don't know how to do this correctly, you are going to blow your account multiple times. And I'm telling you because I've done it when I first started trading. I've done it. So I'm telling you that risk management is very important, because if you don't know how to control the capital that you have to trade, you can't trade without capital, right? Capital is your blood. And if you don't have any, you can't be in the game trading. So you have to have a management plan when it comes to risk on every single trade. You have to know how much you're willing to risk per trade, what your reward is per trade. You have to journal this. You have to put it in a journal every single trade. Okay. So that's huge. And then the third thing is trading psychology. This is probably one of the biggest things that I see that makes traders fail is the trading psychology. I see a lot of traders that when they first start trading, they get lucky, they win 10 trades in a row, or they may win for a month straight. They, make these outrageous trades. They get lucky, the market goes in their favor, they double, triple their account, and they're like, holy shit, this is so easy, right? Come to find out, over the next, 2 months, since they don't know any risk management and they haven't studied trading psychology, all that you gained is lost. Okay? All the trades that you've won, all the money that you've won is lost. And knowing the psychology behind trading, controlling your emotions, not letting yourself get in your own way when it comes to trade, becoming scared of the market, panicking when the market goes against you, not knowing where the market should turn, or not knowing what the market is doing and just blindly going into a trade, and you not knowing how to control yourself while you're in a trade. These are all things that have to do with your psychology. And I'm telling you, the trading psychology is huge when it comes to trading Forex. It can literally kill you in this game here of trading Forex. So these three things are hugely important. All right. So these three skills are broken into essentially like 5 steps, right? So let's talk about first the strategy. So the first thing you have to do is you have to pick a strategy, right? And like I said, there are hundreds of strategies out there. I mean, you can go on YouTube and type in Forex strategy or best Forex strategy, and you'll get 100 different videos with 100 different answers, right? And every one of those videos has promised you that, oh my God, I found the gold mine of of strategies, right? Like you just follow the strategy and it works and it's all good and you'll make millions of dollars and blah, 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 blah. Right? I can tell you this, that whatever strategy you're using, you want to make sure that the strategy is around price action. Okay. What is price action, you may ask? Price action is basically the movement of price, right? So you'll see strategies that use a bunch of indicators and different tools on the screen. I mean, sometimes you'll see screens. I've seen screenshots of traders that you can barely see the damn candlesticks on the screen because they got so many indicators on on the charts. Okay. So just make sure whatever strategy you pick is price action based. Okay. Very important. Everything comes to and from price action. That's it. It's got to be around price action. Number two is, like I said before, you have to back test that strategy. You have to go back into the charts and you have to back test. And this is the part that nobody wants to do. The back testing sucks. I can tell you that much. It sucks ass. But you have to do it because you need to know whether or not this strategy works. And if it does work, how often does it work? What is your win to lose ratio going back a year, 2 years on this strategy on chart? Okay. You might notice that some strategies work better on certain pairs. Okay. So this is why you need to back test it, because you need the data to be able to be successful. If you don't have the data, you're literally just going out blind. It's like going on a boat without a GPS and you're trying to get to some island in the middle of nowhere. But if you don't have a GPS, how are you going to get there? You don't know how to get there. Same thing. Okay? And the last thing is, with the strategy, it needs to be easy to follow. It needs to be an easy strategy. It can't be something complicated. Okay? The easier the better. The less indicators you use, the better. Okay? So it has to be easy to follow. Easy rules to follow and rules that you actually follow. That's another thing, is you have to write rules for yourself and you actually have to follow the damn rules. Okay? Because if you don't follow the rules, then what the hell did you write them down to begin with? You know? So definitely easy to follow, and you have to follow the rules that you make for that strategy. Okay? So step number 2, that's going to be define your risk. So what do I mean by that? So this goes back to the risk management. So you need to make sure that every time that you're trading one trade, you set your risk to about 1%. So you're only risking 1% of your account. Okay? That is the way that I trade. If you want to trade something different, the max I would tell you to do is 3% of your account. So max 3%. I do 1%. Okay? Because your capital is everything. If you don't have capital, you can't trade. Okay? You need to trade for the long term. This is not a get rich quick deal. Okay? If you're thinking that if you need money now, this is not going to be for you. Okay? So if you need money right now, right this second, to pay your bills, go get a job. Because this is not going to work for you. All right? So you need to treat this like a business, not a hobby. When you treat stuff like a hobby, the hobbies cost you money. They don't make you money. So you got to treat it like a business, like a long-term business. So you need to trade for the long term. Okay? The last thing is your targets. We'll talk about all this stuff. We'll break all this stuff down in other videos. But your targets, they need to be at least 1 to 2 risk reward ratio. So meaning that if you're risking $100, you want to be making, your reward should be $200. If you're risking $50, your reward should be 2 to 1. Okay, so $100, risking $50, making $100, risking $100, making $200. All right, so your risk should be 1 to 2, 1 to 2 risk reward ratio. Okay, if you can't get that out of a trade, then you probably shouldn't take that trade. But we will break all this stuff down. I just want you to write down these rules. Write this stuff down. All right, so step 3 is get a demo account. For everybody that's new here that hasn't traded before, you're going to get a demo account. Okay? You're not going to trade live for a while. There's no reason for you to trade live if you don't know what the hell you're doing. Okay? So there's no point in trading a live account with real money if you don't know what you're doing. You're just essentially, if you're doing that, you are going to end up paying tuition for your education because you will lose. And you'll just be paying the banks for it, for your education. And it'll be a pretty big, expensive education. Okay? So get a demo account. This is how you learn how you learn risk management, because you're not risking any of your own money, right? So there's no risk in you losing money, any real money at least. So lots of learning. Okay? Demo trading is forgiving. You can make mistakes on it, and it doesn't matter. You can blow 150 accounts, and it doesn't matter. It doesn't affect your life. It doesn't affect your livelihood because you're not trading real money. So getting a demo account, very important. Okay. We'll talk about brokers in another video. So I'm going to break all this stuff down for you and show you some of the brokers that we deal with that are good brokers. But for right now, just know these steps, what you're going to get into. Okay. So let's go to step number 4 here. All right. So step 4 is going to be set a trade goal. So here's what I want you to do. Okay. Once we start going at this and once we start trading, the goal would be to take 50 trades in the next 3 to 6 months. Like I said, this is not a get rich quick. If you're going to do this for real, okay, remember this skill, once you learn it, you'll have it forever. Okay, so it's just like going to college, right? You're just not going for 4 years. Okay, so just keep that in mind. If you really want to do this, it's going to take time to learn, but if you put in the work, I can definitely guarantee you will be rewarded. And it's a life lesson that you're going to get out of this. You'll have it for life. So take 50 trades in the next 3 to 6 months. You're going to journal every trade. I'm going to give you a trading journal so you can write down each trade. Okay? You're going to write down the pair, the lot size, time, date. You'll see it all on the trading journal, but you're gonna journal every trade. And in that trading journal is also going to have questions for you, like how are you feeling? How positive are you on this trade? Things of that nature. So, and you'll see why once you do the 50 trades and you journal each trade, you'll see a pattern develop. And that's why it's so important to journal it. Now, throughout these 50 trades, you're going to stick to your strategy. You're not going to switch strategies. You're going to give it 50 trades. Give the strategy 50 trades over the next 3 to 6 months. Okay? That way we can have consistent data. Okay? And you're gonna hear me say consistent a lot, because to win in Forex, you have to be consistent. Consistency is huge. You cannot be doing one thing at one trade and something completely different in another trade. You have to be consistent in Forex. Consistency is key. And then final step here is step 5, and that's review and improve. So once you have the 50 trades, we're going to put all this data into an Excel spreadsheet. And this is where you're going to see all of the data spread. And you're going to see what you did right, what you did wrong. We're going to review it, and then you're going to learn from it. And then we're going to do it. And then we'll go ahead and move on to doing the full strategy. But you need to understand what it is that you're doing right, what it is that you're doing wrong. The only way to do that is to journal each trade, collect all the data, and then review it. Once you review it, then you can improve it. Okay? So, I think one of the things that I did when I was first started trading is I got myself a journal, like a journal, like a high school journal, like those little books that they sell for high school kids. It costs like $1.50 or something at Walmart, and I probably got a pack of 5, and I have all 5 of those books filled with notes, stuff, all kinds of stuff written down when I first started trading. So, very important to get one of those books. Don't save it on your computer or anything. It's so much better when you handwrite stuff. It's just different. I know technology makes it a whole lot better when you can save files and all this other stuff, but trust me, when you have it written down on paper, it is so much more impactful when you have it on paper. Okay? So those are the 5 steps. Those are the 3 major core things that you need. Those are the 5 steps within them. Okay? So what I'm going to do next is I'm going to go through the basic stuff, the kindergarten level stuff that you need to know. Okay? They're basically in a set of videos that are literally like 2 to 3 minutes long. And we're just going to go ahead and roll those videos, and then I'll be back after each one of those videos, all right, to break it down a little bit further, just to make sure that you understand.
The foreign exchange, or Forex market, is the world's largest financial market. The Forex market plays a vital role in the global economy. Every day, trillions of dollars are exchanged from one currency to another. Currency exchange is essential for international business, and the Forex market makes this happen. Forex market participants include governments, businesses, and, of course, investors. Governments use the Forex market to implement policies. For example, when conducting business with another country, whether it's borrowing money, lending money, or offering aid, a country needs to convert its currency into another foreign currency. Businesses can participate in the Forex market to facilitate international trade. Businesses require the Forex market to convert payments for goods and services bought overseas, or to exchange payments from international customers into their preferred currency. And advanced investors use the Forex market to speculate on changes in currency prices. Currency prices change almost constantly during the week because the Forex market is open 24 hours a day, excluding weekends. During the week, it has to be open around the clock because of the global nature of the economy. Investors profit when they buy a currency and its price increases. Investors can also sell or short a currency in anticipation of a price decrease. Currencies trade in 2 pairs, which means the value of one currency is always stated relative to another currency. The two-sided nature of pairs is a little confusing at first, but in practice it's quite simple. Let's look at an example trade using the Euro-US dollar currency pair. Even though there are two currencies involved, the pair itself acts like a single entity, similar to a stock or commodity. Let's suppose that an investor thinks Europe's economy is going to grow faster than the United States, and as a result, she thinks the euro will strengthen against the US dollar. She can buy the Euro-US dollar pair to speculate on her assumption. If the pair rises, she'll make money. Conversely, if the pair falls, she'll experience a loss. Investors buy and sell currency pairs using margin. The process of buying and selling investments with margin is much different than buying or selling an investment like a stock. Margin is borrowed money used to purchase securities in a margin account. The amount of margin you'll need varies between currency pairs and the size of a trade. Currency pairs typically trade in specific quantities, known as lots. There are several different lot sizes, but the two most common are standard and mini. The margin requirements for mini lots are usually around $100, and standard lots are around $1,000. These margins might seem like small dollar amounts, but it's important to understand that the lots are highly leveraged. Leverage is using a small amount of money to control a very large amount of currency. Most Forex investors buy and sell currency pairs using leverage. In fact, leverage is a key feature of this market. The leverage associated with currency pairs is one of the biggest benefits of the Forex market, but it's also one of the biggest risks. Leverage gives investors the potential to make large profits or large losses. That's because losses from investments using leverage can grow exponentially and spiral out of control. But if investors manage risk and limit leverage, they can possibly capture the benefits of Forex investing. These benefits include the ability to trade 24 hours a day and capitalize on different market trends. As stated earlier, the Forex market is, by far, the world's largest financial market, with trillions of dollars changing hands every day. The sheer size of the Forex market means it can influence other asset classes, such as stocks, bonds, and commodities. For example, if the US dollar experiences a downtick, it impacts commodities because they're typically priced in US dollars. This, in turn, raises the costs of goods and is inflationary. As a result, interest rates may rise, causing bond prices to fall. All of this can impact the stock market. As you can see, one change in the Forex market can have a ripple effect across several markets. This is just one example of how the Forex market can influence other asset classes. Because the Forex market is the world's largest financial market, it sets the foundation for how other asset classes perform. The Forex market's widespread influence may appeal to investors who are interested in global economics. These investors like learning about other countries, their currencies, how these pieces all fit together, and how the global economy works.
A currency pair is the quotation of the relative value of a currency unit against the unit of another currency, which is seen in symbols in the Forex market. For example, if you are trading the euro against the US dollar, you will see it as EUR/USD. The first currency in a pair is called the base currency, and the second currency is called the quote currency. Majors are the most commonly traded pairs, and these include the Euro-US dollar yen, sterling US dollar Swiss franc, Aussie US dollar, and US dollar Canadian dollar. If you have noticed, US dollar is always in a major currency pair. The majors make up about 85% of the Forex market, resulting to high liquidity, causing high trading volumes and volatility, creating multiple trading opportunities. The cross-currency pairs does not include the US dollar in a pair. However, this pair includes one of the major currency. A good example of this is the Euro-Swiss franc. The exotics are pairs that include one major currency and an emerging market, such as the Euro-Singapore dollar and the Euro-South African rand. What is a pip? Pip or pips means percentage in point. This is the unit of measurement to express the change in value between two currencies. A pip is usually 1/10,000 and is usually placed in the fourth decimal place. There is an exemption to this rule, however. This includes the Japanese yen, which is denoted in the second decimal place. There are brokers that quote currency pairs in the fifth or third decimal place. This is called fractional pips, or pipettes. To further understand what pip is, let's have an example. Let's say you bought one lot of Euro/US dollar at an exchange rate of 1.1225 and it dropped to 1.1215. You actually lost 10 pips. However, if the rate went to 1.1240, you profited 15 pips. Calculating a pip. How do you calculate a pip? In our previous lesson, What is a pip?, we found out that it is the 1/10,000th and is denoted in the 4th decimal place. Hence, a pip is equal to 0.0001. How to calculate the value of 1 pip? Let's say that the euro/US dollar exchange rate is 1.0935. We divide the pip in decimal to get the exchange rate, and the answer is the value of 1 pip of euro/US dollar. Hence, 1 pip of euro/US dollar is worth 0.00009144. How do you calculate the lot value of 1 pip? You want to buy 100,000 of euro/US dollar, and the exchange rate is 1.0935. To get the value of each pip, we multiply the value of 1 pip by your lot value. Hence, the value of each 1 pip in your possession is worth 9.14. How do you calculate your profits with pips? Let's say that euro/US dollar bid ask price is 1.0929 and 1.0935. You bought 100,000 of euro/US dollar at an asking price of 1.0935. A few hours later, the euro/US dollar quote has now changed to 1.0950 and 1.0965. Your exchange rate has increased to 1.0950 and you decided to close the deal. To calculate how many pips you have earned, simply subtract the ask price which you bought to the bid price, then multiply it by 10,000. You receive 15 pips profit. Now to calculate your profit, take the number of pips you gained and multiply it by the value of your pips. What is leverage? Leverage is used by traders to elevate their market exposure. To make it simple, here's an example. You wanted to invest $1,000 and want to buy 1 lot of euro/US dollar. If you went to a bank, usually 1 lot of euro/US dollar cost 100,000. You can't afford that, so you decided to go online and get a broker. Your broker offered you a 1 to 400 leverage. What does that mean? Simply, you get the asset price, which is 100,000, divided by the leverage, and you will get the margin, which is $250. Easy, right? With leverage, you can now buy 1 lot of euro/US dollar for only $250 instead of 100,000. So what really is a leverage? Leverage gives you more buying possibility, which you get the same asset for a much lower margin. What is margin? Margin is the amount of money that participates in a position or trade. In our example, we have bought 1 lot of euro/US dollar for $250, which is the margin. Now in MT4, the margin is automatically calculated, but how do you do it manually? Let us have an example. You invested $1,000 and you bought 1 lot of euro/US dollar, which cost 100,000. But since you have a leverage of 1 to 400, the margin will now only be $250, since 100,000 divided by 400 is 250. Simple, right? Margin level. What is margin level? Margin level is used to determine if a trader can take new positions or not. Now, how do you calculate this? In our MT4 example, our margin level, which is 39,945.12%, and is automatically calculated. To do this manually, we are going to use the formula equity divided by margin multiplied by 100 equals margin level in percentage. Hence, 99,862.80 divided by 250 equals 399.4512 times 100 equals 39,945.12. It's that simple. Change the
All right, guys, welcome back. So, as you saw in those videos, a lot of just, that's like the kindergarten stuff that you should know about Forex. Okay. So, I want to talk about a couple more things here, and then we'll go ahead and call it a day. So, what are the Forex pairs? Okay. So, when it comes to the currencies, currencies have no tradable value unless they are compared to another currency. That's why you see them in pairs. So euro versus USD, USD versus Japanese yen, the pound versus the US dollar. So for this reason, all the currencies are traded in pairs, which are usually referred to as Forex pairs or currency pairs. All right, guys. So here are some of the most commonly traded Forex pairs. You have AUD USD, that's Australian dollar versus the US dollar. You have Euro Euro pound, so that's the euro dollar versus the pound dollar. You have pound USD, which is obviously the British pound versus the US dollar. USD Jappy, so that's US dollar versus Japanese yen. There's over 27, 28 different pairs that are the major pairs. So when you combine all these different pairs, they make out about 27 or 28 different pairs that you can trade, okay, that are most common. There are also exotic pairs. They're called exotics because they're from third world countries, right? So you have like the Russian ruble, Turkish, things of that nature. But the one disadvantage about trading those specific pairs is that the spread on them are huge. And if you don't know what a spread is, we'll talk about that in the next video. So, but the spread on them are huge, so definitely not worth trading them. So you want to trade the majors, the major pairs. So anything with AUD, anything with Australian dollar, US dollar, pound, euro, yen, Swiss. So any of those pairs. All right. So let's move on here to what are the trading sessions? So due to the 24-hour nature of Forex markets, trading times are split into essentially three major chunks or trading sessions. These are generally referred to as the Asian session, the European session, and the US session. Okay. So those are the three major sessions. Now, in the Asian sessions, you basically have a bunch of smaller, like Sydney, Tokyo, but essentially it's one big Asian session because that's essentially where most of the markets are trading during that time. So let's take a look here. So as you can see, London is from 3 a.m. To 11 a.m. and that is this is all Eastern time. New York's from 8 to 4. Sydney is from 5 to 1. Tokyo is from 7 to 3. All right. So Sydney and Tokyo basically make up the Asian session. And then, of course, London and New York. Now, as you can see, out of all these sessions, the two that are the most popular because they provide the most liquidity. That's London and New York, but London is definitely the biggest trading session in Forex because that session does have the most liquidity out of any of the other sessions. Okay, but London, New York, Sydney, Tokyo. All right, so essentially London, New York, and Asian. All right. What are the lot sizes? So lot size is basically what you're going to use to determine how much money you're going to make per pip. Okay, so every time that you go up or down a pip, depending on whether you buy or sell, and the lot size that you use determines essentially how much money you're going to make per pip. Okay, so standard is micro, which is 0.01, and that's 10 cents a pip. Mini, which is 0.1, that's $1 a pip, and then standard lot, which is $10 a pip. Okay, now when we talk about the micro lots here, basically it goes like 0.02 would be 20 cents, 0.03 would be 30 cents, 0.04, it keeps going up until 9. So 0.09, that's 90 cents, and then you get to 1, which is a mini lot. And then mini lot works the same way. So 0.1 is $1, 0.2 is $2, 0.3 is $3, so forth and so on until you get to 9. And then you're at $9 basically. 0.9 is $9, and then you get to standards, and then you're talking $10 a pip. So 2 standards at $20 a pip, 3 standards $30 a pip, so forth and so on all the way up. So those are the lot sizes. When you first start out, depending on how much capital you have, will determine what lot size you're going to be trading. Okay, so just as a fun fact, okay, fun fact, real quick. So let's say you're starting out with $100, you're going to be trading micro lots. If you have, let's say, $1,000, you're going to be starting out with mini lots. And if you have $10,000, you would be starting out with standard lots. And the reason I say that is it's not that you can't trade a standard lot with $500. We go back to what we talked about earlier in the video, and that's risk management. And again, if you want to do this correctly, the right way, to where your capital is actually going to last and it'll grow, then you'd want to follow the standards that I'm telling you now, which is if you have 100, it's a micro, 1,000 a mini, 10,000 standards, and essentially you grow your accounts to these different levels. Okay, there are levels to this. So if you start out small, you're going to grow the account small. The more money that you initially start out with once you start live trading, then obviously the faster you can grow your account. Okay. I realize obviously not everybody has 10,000 sitting in the bank somewhere that they can just splurge on trading. Okay. But you have to, if you're going to start small, you have to build it, and you have to know that up front. Okay. But building it makes you a whole lot of a better trader, because you're not going to be scared. You're going to get a lot of practice in when you're trading micro lots. So I think it's always better. You just become a better trader because of it. So, and you become a lot more humble too. So this here is the amount of leverage coincide with the actual amount of money that you would need. So if you go with, let's say, an American broker, which are regulated, American brokers only go up to 50 to 1 leverage. So if you're going to trade with an American broker and you plan on trading, let's say, a standard lot, which is 100,000 in traded money, you're going to need at least $2,000. Okay. If you were to trade this, obviously this right here, where it's talking about amount traded, this is all one standard lot right here, which is 100,000, right? So as you can see, the further you go up on the leverage, the less money you need to trade a standard lot. Okay, but keep in mind that if you go with a U.S. broker, you're going to be capped at 50 to 1. Okay, so you're going to need 2,000 to do a standard lot, and this is what I'm telling you, that why, if you want to keep the capital safe, secure, you want to actually have 10,000, not 2,000. Okay, but if you go with an overseas broker, there are some brokers that are overseas, that are regulated, that do accept U.S. citizens as clients, and we'll discuss some of those when we talk about brokers in the other video. All right, but as you can see, leverage is huge in the forex market, and this is why a lot of people don't need a lot to get started, just to get started to trading, right? Because there are some brokers out there that give you 3,000 to 1 leverage. It's ridiculous. But at the same time, leverage can be so bad for you, because you'll be you'll over leverage your account essentially and over trade it. But we'll get into that in a later video. We'll talk about all that stuff in a later video. But I just wanted to share real quick basic stuff about lot sizes. Okay. All right, guys. So I really hope that you enjoyed this first video. Couple of updates. I've created a Facebook group. Links are going to be in the description. What I want you to do is go ahead and click the link, ask to join the group, because a lot of the stuff that will be going over, I post on that group as well. Okay, that way we can talk to each other all the time. All right. Also in the description is going to be links for, of course, websites, emails, and all that stuff. Guys, thank you so much for taking the time to watch this video. Again, this is just literally the very beginning video. There is so much to learn, and I can't wait to share everything with you guys. Just be patient. If you're already a trader, we'll get there. Guys, if you want to do me a favor, please, if you can go ahead and comment below. One of the things that I want to know is I want to know what kind of group I have here. So do me a favor in the comments below, let me know if you are new to trading, or if you have been trading, how long have you been trading, and what are some of the struggles that you find? What are you looking to get out of this channel if you're already an experienced trader? If you're new to trading, comment below, let me know. So just to speed up this process here, the upload schedule for videos. So instead of doing just one video a week, I'm going to do 2 videos per week. Okay, just so we can go through this a lot faster and get to the meat of the actual strategy and trading and all that stuff. Once we get to the actual trading part, then we're going to do one video per week. But until we get there, I'm going to just do 2 videos per week so we can get to that part of the videos of the training. All right, guys. Guys, one last thing. Thank you so much for watching my videos. I really appreciate the fact that you take the time to watch my videos. I really hope that I've added value in each of the videos that I make for you guys, and I hope that you're learning something. As always, guys, please make sure you subscribe to the channel. Please like and share the videos if you found value in them. And also, don't forget to visit our website at www.fxntradinggroup.com. Once again, guys, thank you so much. I'm truly blessed.